Section 5 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 1, Before Our Very Eyes, Part 3. In late 2005, regulators decided to take a look at the changing mortgage market. Sabeth Siddiq, the Assistant Director for Credit Risk at the Division of Banking Supervision and Regulation at the Federal Reserve Board, was charged with investigating how broadly loan patterns were changing. He took the questions directly to large banks in 2005 and asked them how many of which kinds of loans they were making. Siddiq found the information he received very alarming, he told the Commission. In fact, non-traditional loans made up 59% of originations at Countrywide, 58% at Wells Fargo, 51% at National City, 31% at Washington Mutual, 26.5% at Citi Financial, and 18.3% at Bank of America. Moreover, the banks expected that their originations of non-traditional loans would rise by 17% in 2005 to $608.5 billion. The review also noted the slowly deteriorating quality of loans due to loosening underwriting standards. In addition, it found that 2/3 of the non-traditional loans made by the banks in 2003 had been of the stated income minimal documentation variety known as liar loans, which had a particularly great likelihood of going sour. The reaction to Siddiq's briefing was mixed. Federal Reserve Governor Bees called the response by the Fed governors and regional board directors as divided from the beginning. Some people on the board and regional presidents just wanted to come to a different answer, so they did ignore it, or the full thrust of it, she told the Commission. The OCC was also pondering the situation. Former Comptroller of the Currency, John C. Dugan, told the Commission that the push had come from below, from bank examiners who had become concerned about what they were seeing in the field. The agency began to consider issuing guidance, a kind of non-binding official warning to banks that non-traditional loans could jeopardize safety and soundness and would invite scrutiny by bank examiners. Siddiq said the OCC led the effort, which became a multi-agency initiative. Bees said that deliberations over the potential guidance also stirred debate within the Fed, because some critics feared it would both stifle the financial innovation that was bringing record profits to Wall Street and the banks, and would make homes less affordable. Moreover, all the agencies, the Fed, the Office of the Comptroller of the Currency, the Office of Thrift Supervision, the FDIC, and the National Credit Union Administration would need to work together on it, or it would unfairly block one group of lenders from issuing types of loans that were available from other lenders. The American Bankers Association and Mortgage Bankers Association opposed it as regulatory overreach. The bankers pushed back, Bees told the Commission. The members of Congress pushed back. Some of our internal people at the Fed pushed back. The Mortgage Insurance Companies of America, which represents mortgage insurance companies, weighed in on the other side. We are deeply concerned about the contagion effect from poorly written or unsuitable mortgages and home equity loans, the trade association wrote to regulators in 2006. Quote, the most recent market trends show alarming signs of undue risk-taking that puts both lenders and consumers at risk, unquote. In congressional testimony about a month later, William A. Simpson, the group's vice president, pointedly referred to past real estate downturns. We take a conservative position on risk because of our first loss position, Simpson informed the Senate subcommittee on Housing, Transportation, and Community Development and the Senate Subcommittee on Economic Policy. Quote, however, we also have a historical perspective. We were there when the mortgage markets turned sharply down during the mid-1980s, especially in the oil patch, and the early 1990s in California and the Northeast, unquote. Within the Fed, the debate grew heated and emotional, Sadiq recalled. It got very personal, he told the commission. The ideological turf war lasted more than a year, while the number of non-traditional loans kept growing and growing. Consumer advocates kept up the heat. In a Fed Consumer Advisory Council meeting in March 2006, Fed Governors Bernanke, Mark Olson, and Kevin Warsh were specifically and publicly warned of dangers that non-traditional loans pose to the economy. Stella Adams, the executive director of the North Carolina Fair Housing Center, raised concerns that non-traditional lending, quote, may precipitate a downward spiral that starts on the coast and then creates panic in the East that could have implications on our total economy as well, unquote. At the next meeting of the Fed's Consumer Advisory Council, held in June 2006 and attended by Bernanke, Bees, Olson, and Warsh, several consumer advocates described to the Fed governors alarming incidents that were now occurring all over the country. Edward Sivak, the Director of Policy and Evaluation at the Enterprise Corporation of the Delta in Jackson, Mississippi, spoke of being told by mortgage brokers that property values were being inflated to maximize profits for real estate appraisers and loan originators. Alan White, the supervising attorney at Community Legal Services in Philadelphia, reported a huge surge in foreclosures, noting that up to half of the borrowers he was seeing with troubled loans had been overcharged and given high interest rate mortgages when their credit had qualified them for lower cost loans. Hattie B. Dorsey, the president and chief executive officer of Atlanta Neighborhood Development, said she worried that houses were being flipped back and forth so much that the result would be neighborhood decay. Carolyn Carter of the National Consumer Law Center in Massachusetts urged the Fed to use its regulatory authority to prohibit abuses in the mortgage market. The balance was tipping. According to Sadiq, before Greenspan left his post as Fed chairman in January 2006, he had indicated his willingness to accept the guidance. Ferguson worked with the Fed board and the regional Fed presidents to get it done. Bees supported it, and Bernanke did as well. More than a year after the OCC had begun discussing the guidance, and after the housing market had peaked, it was issued in September 2006 as an interagency warning that affected banks, thrifts, and credit unions nationwide. Dozens of states followed, directing their versions of the guidance to tens of thousands of state-chartered lenders and mortgage brokers. Then, in July 2008, long after the risky, non-traditional mortgage market had disappeared and the Wall Street mortgage securitization machine had ground to a halt, the Federal Reserve finally adopted new rules under HEPA to curb the abuses about which consumer groups had raised red flags for years, including a requirement that borrowers have the ability to repay loans made to them. By that time, however, the damage had been done. The total value of mortgage-backed securities issued between 2001 and 2006 reached $13.4 trillion. There was a mountain of problematic securities, debt and derivatives resting on real estate assets that were far less secure than they were thought to have been. Just as Bernanke thought the spillovers from a housing market crash would be contained, so too policymakers, regulators, and financial executives did not understand how dangerously exposed major firms and markets had become to the potential contagion from these risky financial instruments. As the housing market began to turn, they scrambled to understand the rapid deterioration in the financial system and respond as losses in one part of that system would ricochet to others. By the end of 2007, most of the subprime lenders had failed or been acquired, including New Century Financial, AmeriQuest, and American Home Mortgage. In January 2008, Bank of America announced it would acquire the ailing lender Countrywide. It soon became clear that risk, rather than being diversified across the financial system, as had been thought, was concentrated at the largest financial firms. Bear Stearns, laden with risky mortgage assets and dependent on fickle short-term lending, was bought by J.P. Morgan with government assistance in the spring. Before the summer was over, Fannie Mae and Freddie Mac would be put into conservatorship. Then, in September, Lehman Brothers failed, and the remaining investment banks, Merrill Lynch, Goldman Sachs, and Morgan Stanley, struggled as they lost the market's confidence. AIG, with its massive credit default swap portfolio and exposure to the subprime mortgage market, was rescued by the government. Finally, many commercial banks and thrifts, which had their own exposures to declining mortgage assets and their own exposures to short-term credit markets, teetered. IndyMac had already failed over the summer. In September, Washington Mutual became the largest bank failure in U.S. history. In October, Wachovia struck a deal to be acquired by Wells Fargo. Citigroup and Bank of America fought to stay afloat. Before it was over, taxpayers had committed trillions of dollars through more than 24 extraordinary programs to stabilize the financial system and to prop up the nation's largest financial institutions. The crisis that befell the country in 2008 had been years in the making. In testimony to the commission, former Fed Chairman Greenspan defended his record and said most of his judgments had been correct. "I was right 70% of the time, but I was wrong 30% of the time," he told the commission. Yet the consequences of what went wrong in the run-up to the crisis would be enormous. The economic impact of the crisis has been devastating, and the human devastation is continuing. The official reported unemployment rate hovered at almost 10% in November 2010, but the underemployment rate, which includes those who have given up looking for work and part-time workers who would prefer to be working full-time, was above 17%, and the share of unemployed workers who have been out of work for more than 6 months was just above 40%. Of large metropolitan areas, Las Vegas, Nevada, and Riverside, San Bernardino, California, had the highest unemployment. Their rates were above 14%. The loans were as lethal as many had predicted, and it has been estimated that ultimately as many as 13 million households in the United States may lose their homes to foreclosure. As of 2010, foreclosure rates were highest in Florida and Nevada. In Florida, nearly 14% of loans were in foreclosure, and Nevada was not far behind. Nearly 1/4 of American mortgage borrowers owed more on their mortgages than their home was worth. In Nevada, the percentage was nearly 70%. Households have lost $11 trillion in wealth since 2006. As Mark Zandi, the chief economist of moody'seconomy.com, testified to the commission, quote, "The financial crisis has dealt a very serious blow to the U.S. economy. The immediate impact was the Great Recession, the longest, broadest, and most severe downturn since the Great Depression of the 1930s. The longer-term fallout from the economic crisis is also very substantial. It will take years for employment to regain its pre-crisis level." Looking back on the years before the crisis, the economist Dean Baker said, quote, "So much of this was absolute public knowledge, in the sense that we knew the number of loans that were being issued with zero down. Now, do we suddenly think we have that many more people who are capable of taking on a loan with zero down, who we think are going to be able to pay that off, than was true 10, 15, 20 years ago? I mean, what's changed in the world? There were a lot of things that didn't require any investigation at all. These were totally available in the data," unquote. Warren Peterson, a home builder in Bakersfield, felt that he could pinpoint when the world changed to the day. Peterson built homes in an upscale neighborhood, and each Monday morning he would arrive at the office to find a bevy of real estate agents, sales contracts in hand, vying to be the ones chosen to purchase the new homes he was building. The stream of traffic was constant. On one Saturday in November 2005, he was at the sales office and noticed that not a single purchaser had entered the building. He called a friend, also in the home building business, who said he had noticed the same thing, and asked him what he thought about it. "It's over," his friend told Peterson. End of section 5 and of chapter 1.